Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, if you hold any digital assets, you're going to want to pay close attention. A really big shift is coming in how your transactions get reported to the IRS, and it all boils down to one brand new tax form. So let's get right into it and break down what it is, and more importantly, what it means for you. You've probably seen this question, right? It's sitting there front and center on the Form 1040. It's the IRS's way of asking, hey, did you do anything with crypto this year? And believe it or not, this simple question is the jumping off point for a massive change that's on the horizon. And that is exactly why we're talking about this today. If you've ever had to check that yes box, you know the absolute nightmare of digging through CSV files and transaction histories to figure out your gains and losses. Well, that whole process, it's about to get a major overhaul. We're entering a new, much more standardized era of tax reporting. Okay, so here's what we're going to cover to get you completely up to speed. First, we'll meet the new form itself. Then, we'll figure out who exactly has to send it. This is a big one. We'll walk through the rollout timeline, break down what info will actually be on the form, and then we'll wrap up with what you can do right now to get ready for all of this. So, what is this big change all about? Well, the IRS is finally introducing a specific form just for digital asset transactions. It's basically their official answer to the chaos that's been crypto taxes for, well, years now. So say hello to Form 199DA. Honestly, the easiest way to wrap your head around this is to think of it as the crypto version of a Form 1099B. If you've ever sold stocks, you know the deal. You get that 1099B from your brokerage, and it neatly lists everything out for you. The 1099DA is designed to do that exact same thing, but for your digital assets. Look, this is a huge shift in how things are done. We are literally moving from a world where the entire burden was on you to piece together every single transaction to a new system where brokers are going to give you a standardized summary. It is a massive step towards bringing some much-needed clarity to the space. Okay, so the big question now is, who the heck is a broker? Who is actually going to be sending you this new form? The answer, it turns out, is a lot broader than you might think, and it's probably one of the most important parts of these new rules. So this is the official language from the IRS. Now, the key phrases to latch onto here are any person and stands ready to affect sales. That language is intentionally broad because it's meant to catch a whole lot of different platforms and services in its net. So what does that actually look like in the real world? Well, the obvious ones, of course, are the big centralized exchanges. But this new definition also includes things like crypto ATMs and kiosks, and even some payment processors that let you use digital assets to buy things. Now, what's just as important is who is not a broker. The IRS made it pretty clear that if you're just validating transactions, through mining or staking, you're not a broker. Same goes for the folks who just make the software or hardware wallets that let you control your own keys. That's a really key distinction. All right, let's talk about the timeline, because this isn't all happening overnight. The IRS is actually phasing these new rules in over a couple of years, which is a really crucial detail for taxpayers and for the brokers themselves. So here's how it's going to roll out. For all of your transactions in 2025, brokers only have to report your gross proceeds, basically the total amount you sold for. But then, for transactions in 2026, they also have to start reporting your cost basis, which is what you need to figure out your profit or loss. But, and this is a big but, that only applies to certain assets, which we're about to define. So, what's the bottom line here? It means that the very first Form 1099-DA you get in early 2026 is going to be pretty basic. It'll just have the gross proceeds. The full-blown reporting, the kind that includes your cost basis, that won't be required until the year after that, and even then, only for specific situations. Okay, so this is where we get into the nitty-gritty. What information is actually going to be on this form, and what in the world are these covered securities we keep mentioning? Understanding this difference is really the key to knowing what your broker will handle versus what you still have to track yourself. It all comes down to these two terms. A covered security is pretty simple. It's any digital asset you buy on a broker's platform starting on January 1st, 2026. Non-covered is basically everything else, all the assets you bought before that date or any assets you transfer in from an outside wallet. Let's put this into a real-world example. Say you buy some Bitcoin in 2026 on an exchange. That's a covered security, which means your broker has to report what you paid for it. But what about that Ethereum you bought way back in 2022? That's non-covered, so the broker is not required to report its cost basis. The responsibility for that is still on you. Okay, so after all that, what can you actually do right now to prepare for these changes? Let's get into a simple action plan. It really just comes down to 3 things, and they're super important. First, keep doing what you're hopefully already doing. Keep detailed records of everything. Second, make sure you know your cost basis, especially for all those older assets that are going to be non-covered. And third, look, if this is all feeling a bit much, think about talking to a tax pro who knows their way around this stuff. And look, this isn't just me giving you friendly advice. This is straight from the horse's mouth, the IRS itself. It's a powerful reminder that even with all this new broker reporting, at the end of the day, the ultimate responsibility for what's on your tax return, it's you. Your own records are your ultimate source of truth. And this is why keeping your own records is still absolutely critical. For any crypto you owned before 2026, or anything you moved onto an exchange from a private wallet, your broker simply doesn't have the full story. And that means when you eventually sell it, figuring out the correct cost basis, and therefore your correct capital gain or loss, is still 100% your job. So you boil it all down, all the rules, the timelines, the definitions, and it all comes back to this. One new form that's designed to bring a level of standardization and clarity to crypto taxes that we've just never seen before. Which, of course, leads us to the big final question. With this new layer of mandatory reporting, this level of standardization, is this finally the end of the Wild West era for crypto taxes? It's a huge step in that direction, but I guess only time will tell for sure.